Hello and welcome to Looking at the Markets with David Modell. I've got a repeat guest here. He is Mr. Seth Golden from phenomgroup.com. Definitely recommend you check out phenomgroup.com. I'll put a link in the description below this video. We're going to learn more about that and what's going on in the markets, where they might be headed in this crazy melt-up kind of a market. Is it time to get in, to stay in, or is it time to get the heck out? Mr. Seth Golden, welcome back to Looking at the Markets, sir.
Thank you. I love being on your show, David. Glad to, meet your audience once again and, give them some background on Phenom Group. And love talking about the markets. So ready to go.
Yeah, let's do this. All right. Well, as I recall, the last time you were on the show, you're calling for a small pullback that should be bought. And I think that was last July.
Right.
And we got the pullback in August,
Yep.
and from there it's been just a nonstop ride upwards. So how did you do in 2019?
2019 was a standout year. I manage the Golden Capital portfolio, which is about $40 million in capital under management. But I also run phenomgroup.com, which is a website, a financial website. We have research reports. We have state of the market videos every week. We deliver trade alerts and trading strategies. And within the Golden Capital portfolio, we generated a 61% return last year. And for our traders and investors at phenomgroup.com, we delivered 242 trades last year, of which we had a 98% hit rate. So it was a very successful year for us. Of course, it was you could almost do no wrong last year. Every asset class just about went up.
Yeah.
So, that's, kind of rare. But beating the market is a whole other thing. And we definitely did a good job of beating the market, not just, meeting that 31% total return for the S&P 500. It's a good year.
Yeah, sounds like a great year. So we have the Federal Reserve on pause, on hold, basically. An expected earnings rebound, but also a virus scare going on.
Yeah.
So do you think the market's going to continue to rally, and why?
We actually just got breaking news, David. I'm not sure if you saw, literally within the last 20 minutes, just before we came on air here, Apple just announced that it would not be meeting its revenue and earnings guidance. So, there are Globex futures that are currently trading, and I saw them basically cut in half. We're in rarefied air when it comes to, this market conditions presently. We got the S&P 500, 3 standard deviations above its 200-day moving average. Usually, this is the type of overbought condition that is met with a near-term pullback. It's like we talked about at Phenom Group in our trading room just the other week. The market rarely gives you 2 opportunities to rebalance your portfolio. I think we're in that stage right now where investors might consider rebalancing their portfolio, looking at their winners, possibly looking where they can trim some market exposure, given how overbought we are, given the overextended conditions in the market. We've managed to work off some of the frothy sentiment, but so far as overbought conditions, they're still present in this market. When we enter the trading week with new information, Apple, this is a big mega tech, consumer goods related company, that just warned. The coronavirus being what it is, presenting investors with a bit of an unknown. What we do know is that China's economy is, for lack of a better word, quarantined. You don't want to say the entire economy is shut down, but it's definitely seen better days. And we don't necessarily know if we've hit that climactic point in these viral or these epidemic stages or their life cycle. We don't know that we've hit that climactic point yet. It doesn't hurt to have some extra cash on the sidelines. We've got 10 and a half months left in this trading year. I think caution, being a little bit more prudent than you otherwise would, maybe taking, the foot off the gas pedal at this point in the year, is somewhat warranted.
Makes sense to me. So, is it possible to find bargains in this market then? How would you position yourself even to find bargains if they exist?
Yeah, it goes back to, when you get these kind of overextended moves in the market, it's hard to find those bargains. I look at CTA positioning, I look at long short portfolio positioning and their exposure, and they're at levels we haven't seen in quite some time. I look at, how much cash, the Bank of America Merrill Lynch fund manager survey shows that they got 4.2%, cash holdings. That's the lowest it's been since 2013, which kind of signals that everybody's in this boat. They've leveraged themselves pretty good already. How much more upside is, left here intermittently? So it's hard to find those bargains. I would say there's still a lot of opportunity out there. I personally, I like to trade volatility, and I like to trade retail stocks, the actual retail chain names. And I think there's a lot of opportunity going into the retail reporting season starting tomorrow with Walmart. Walmart is going to, basically set the tone for the remainder of the retailers that will report afterwards. And I think you're going to find a lot of opportunity in that, in the retail complex. So tomorrow's going to be a bellwether day. You got Walmart reporting. We just had, here over the weekend, we've got, Apple warning. So we're going to see some volatility, and we're going to see those opportunities develop. But really, those opportunities can only be captured if you got some cash on the sidelines.
Yeah, smart to keep some dry powder, as they say. I'm checking right now at the volatility index because I know you like to trade products related to the VIX or volatility index. It's right now it says 13.68 for the VIX. I've found that the average has been about 14 or 15 lately because of the virus outbreak. There was a down day, 1.7% down in the S&P 500. That was about a week and a half to 2 weeks ago.
Yeah.
And yet the VIX is just kind of holding steady at around 13, 14, 15. Is this something that we should pay attention to? How are you playing this?
Yeah, so in this environment where, look, the market just keeps melting up, knowing where, your institutions are positioned, they're positioned for the long run. When they've got this much exposure, you get what they call a fat tail in the market, meaning that there's depth behind these positions. These are not short-term positions. These are duration. So you don't necessarily want to bet against. I think volatility is basically signaling that at this point, it's prepared for some disruption in the market. It's prepared for the possibility of a corrective period. How much of a correction is, if I had a crystal ball, right? But don't be surprised if over the next 30 days, we get something on the magnitude of a 3 to 5% correction, because the VIX itself is not necessarily a confirmation tool. However, it hasn't gotten back down to those levels that we saw pre-coronavirus, 12 and upper 11s. If you add on to that the volatility complex staying just below 100, if you will, it's signaling also that it's not just the coronavirus. You've got Super Tuesday coming up, so you've got the election implications baked into VIX options, which is keeping VVIX elevated. But I guess if you cluster all that information together, it does beg of caution. It does beg of setting your as an investor, as a trader, you want to set your expectations along the right paradigm going forward. And I think that paradigm suggests bit more volatility over the next 30 days, and a higher probability for some type of corrective phase, distribution, if you will.
Yeah. I mean, you alluded to fat tails. That implies that there is perhaps a heightened possibility of the you-know-what hitting the fan and the market going from complacency to fear very quickly. We've seen how fast this can happen. I've made a number of videos pointing out what's wrong beneath the hood of this economy. Yeah, I know manufacturing has gotten a little bit better, but still not particularly great.
Right.
There are cracks in the foundation.
Absolutely.
And you also have a lack of breadth. You've got a handful of stocks, the FANGs as they call them, the tech stocks, really pulling the weight of this market. Is it possible even to make an argument against any of these things? I mean, is there an argument that the economy isn't terrible right now?
It's not the ideal economy. I think that's the best way I can characterize it, because it is increasingly dependent, more so than prior years. The economy is riding the coattails of the consumer. The consumer or the household balance sheet remains strong. It remains healthy. But we've also seen a shift in how consumers are spending. We've never had a expansion cycle, A, this long, B, with the personal savings rate moving higher throughout the expansion cycle. Like, this hasn't happened since the 1970s. So you have a more cost-conscious and disciplined consumer than you used to have. It's all fine and well and good that the household balance sheet is in fantastic shape. We've literally gone through we had the great financial crisis, which led to the great household deleveraging of debt. So while their household balance sheet is in great shape, they're not spending in the same way that they used to, which has led to a higher savings rate. And this kind of collides with government spending slowing and with business spending, CapEx, if you will, and business investment also being down on a year-over-year basis. So again, it all points to we're riding the coattails and kind of putting the weight of the economy on the consumer. And don't get me wrong, the consumer is 70% of economic activity. But should something startle that consumer to where they start to, close up the purse strings, we got a problem. And when you get an announcement like this over the weekend from Apple, the market's, doing well right now. But should the market, which is, something that also keeps the consumer sentiment high, when the market starts to falter, as we saw in Q4 of 2018, so does the consumer. So does real estate. And it's kind of this domino effect. So it's very fragile. I would say that, if I was to use my own characterization of the economy is healthy, growing at a trend growth pace, but it's fragile with respect to you introduce one, exogenous element into that equation, and it can prove quite disruptive.
Yeah, I agree. I like the word fragile, so at least you're willing to admit that. That's good. And yeah, I'm not trying to paint you as a constantly a bullish person, permabull, as they say. It's not like that at all. You've made a number of calls from time to time to get out and take profits.
Yep. And that's kind of where we are right now. It's not sell everything, but it's definitely look at where you can reduce your exposure and possibly position elsewhere. I don't believe that the department store environment is good. I've been short department stores. We had a short at phenomgroup.com for our members. We shorted, and we issued this as a short trade alert for our members to go short Bed Bath & Beyond. It gave us almost a 20% return in 2 trades over the course of a month. Everybody saw, the debacle that was Bed Bath & Beyond's latest, update from the CEO, and, the stock went down like 30% in after hours. So there's always, you asked me earlier, David, are there opportunities? That's an opportunity. We still think that retail has its strengths and its weaknesses. So there's opportunity.
Yeah, and if people want to get the full story, they will have to go to phenomgroup.com. Link in the description below this video. Also check out Seth Golden's Twitter and stock twits. I know you're pretty active on those. You want to give out your social media info right now?
Yes, at Twitter it's at Seth, SETHCL, and StockTwits it's at Seth Marcus.
Got it. Seth CL on Twitter, Seth Marcus on stocktwits.com. Definitely recommend those. You give out some golden nuggets there. There, you see what I did there? There you go. But you can copyright that. That's okay. You can steal it.
Take a quarter each time.
Yeah. And finally, are there any sectors or specific, speaking of just little nuggets, little tidbits to get people in, are there any sectors that, or particular stocks, you mentioned Walmart, are there any others that you would recommend right now, maybe for a long or short position, if they're just going to buy and hold, let's say?
Yeah, if they're buy and hold, I think we're, like I said earlier, I think we, are on the cusp of, a distribution or a corrective period over the next 30 days or so. But I do remain bullish over the course of 2020. If you're a simple index investor or a sector ETF investor, index ETF investor, you want to keep it short, simple. I think the spiders will do you fine over the course of the next 9 months, and you'll be able to, dollar cost average lower. But I think the XRT, I think that's in for some trouble. I think where it's, going to go into the market this coming week. And I think over the next, quarter, possibly even 6 months, you got a good short opportunity there. The financials, I think, have had their 3-month period in the sun finally, but I think even the financials are a bit stretched at this point. So, in terms of, perma bears, perma bulls, look, I go where the market takes me. And if the market signals, and if there's certain signals, sectors that are signaling overbought conditions, I'm more than happy to short those for a near-term, profit opportunity. Long-term shorts that I think will get you done also, and this, as I always say, to our members, when you're short anything, be prepared in the beginning to take some pain. As a short trader, you have to be prepared to take some pain. I think that department stores like Macy's and Kohl's and Dillard's and Nordstrom's, look, their business models are in dire straits. They've thrown everything they can at these particular, business models. They've done nothing but fail. No matter how many initiatives the CEOs talk about doing, they never work out. And now you got Macy's cutting another 120 plus stores over the next 3 years. I don't think that the analysts can properly model for the revenues and for the earnings simply based on that announcement. And we're going to get guidance from these companies along with their Q4 results over the next 2 weeks. Don't be surprised if the guidance for 2020 does not meet analyst expectations, because the analysts simply can't model for store closures. And you might see these stocks, if they pop, good. That's probably a better short opportunity. But these are, stocks that I like to short long term. The business models aren't getting any better. No matter what they do, unless they introduce grocery, you're stuck with the same business model. Accessories, cosmetics, apparel, and home goods within the department store format. It hasn't worked for the last 10 years. It's not going to work going forward, no matter how much they do, when it comes to their e-commerce. They're all doing the same thing. Every last one of them are doing the same thing. They can't differentiate if you're just doing the same as your peer.
Interesting. So some potential short opportunities. Just to recap, so financials, and if people want to try the ETF, it is XLF for the financials. That's a popular one. And then XRT, that's transports, or the Transportation Index ETF.
That's the retail sector ETF.
I'm sorry. I apologize. I'm sorry. That you're right. Retail. That's retail. And then specific names, possibly Macy's, which is M, Kohl's, KSS. I'm doing these from memory. Let's see. Dillard's. I don't even know what the ticker is for Dillard's. I don't trade Dillard's.
Yeah, DDS.
DDS. Got it. Okay. Shorting is only to be done at your own discretion. Please be careful. You can lose more money than you put into it if you short stocks. So please be careful, folks. All right. Wow. So some actionable ideas here. If you want more actionable ideas, you got to sign up to phenomgroup.com, and also check out the social media for Mr. Seth Golden. We're going to have to revisit this and see if these pan out. The previous interviews always have so far, so I'm feeling I'm feeling good. I'm glad you were willing to lean a little bit bearish into this one. That makes me feel good. Very good. Mr. Seth Golden, thank you for coming on Looking at the Markets. We're going to have to invite you back again in a few months to check these out again. Thank you, sir.
Thank you, David.